Assalamualaikum. Today we discuss about what are the best insurance plan for home mortgage. If you are making down a payment for less than 20% on home, it is essential to understand your option for private mortgage insurance (PMI). Some people simplify cannot afford a down payment in the amount of 20%. Others may select to put down a smaller down payment in favor of having more cash on hand for repair, remodeling, furnishing, and emergencies. What are private mortgage insurance? PMI. Private mortgage insurance (PMI) is type of insurance that a borrower might be required to buy as a condition of a conventional mortgage loan. Most lenders require PMI when a home buyer makes a down payment of less than 20% of the home's purchase price. When a borrower makes down payment of less than 20% of the property's value, the mortgage loan to value (LTV) ratio is over 80%. The higher the LTV ratio, the higher the risk profile of mortgage of the lender. Unlike most types of insurance, the policy protects the lender's investment in the home, not the individual purchasing the insurance. However, PMI makes it possible for some people to become homeowners. So, for individuals who elect to put down between 5% to 19.99% of the residence cost, PMI allow them the possibility of obtaining financing. However, it comes with additional monthly cost. Borrowers must take PMI until they have accumulated enough equity in the home that the lender no longer consider them high risk. PMI cost can range from 0.5% to 2% of your loan balance per year, depending on the size of the down payment and mortgage, the long term, and the borrower's credit score. The greater your risk factor, the higher the rate you will pay, and because PMI is a percentage of the mortgage amount, the more you borrow, the more PMI you will pay. There are several major PMI companies in the United States. They charge similar rates which are adjusted annually. Will PMI is added expense, so it continuing to spend money on rent and possibly missing out on market appreciation as you wait to save up a larger down payment. However, there is no guarantee you will come out ahead buying a home later rather than sooner. So the value of paying PMI is worth considering. Some potential homeowners may need to consider Federal Housing Administration (FHA) mortgage insurance. However, that only applies if you qualify for a Federal Housing Administration loan (FHA). You take away, you will need private mortgage insurance (PMI) if you are purchasing a home with a down payment of less than 20% of the home cost. Beware that PMI is intended to protect the lender, not the borrower, against potential losses. There are four main types of mortgage insurance you can purchase: borrower paid mortgage insurance, single premium mortgage insurance, lender paid mortgage insurance, and split premium mortgage insurance. If you obtain a Federal Housing Authority loan for your home purchase, there is an additional type of insurance you will need: private mortgage insurance (PMI) coverage. First, you should understand how PMI works. For example, suppose you put down 10% and get a loan for the remaining 90% of the property value. 20% $20,000 down and $180,000. With mortgage insurance, the lender's losses are limited if the lender has to foreclose on your mortgage. That could happen if you lose your job and can't make your payment for several months. The mortgage insurance company covers a certain percentage of the lender's loss. For our example, let's say the percentage is 20%. If you still out 85% foreclosed on instead of losing the full $170,000, the lender would only lose 75% of $170,000 or $127,500. On the home principal, PMI would cover the other 25% or $42,500. It would also cover 25% of the delinquent interest you had incurred and 25% of the lender's foreclosure cost. If PMI protects the lender, you may be wondering why the borrower has to pay for it. Essentially, the borrower is compensating the lender for taking on the higher risk of lending to you, versus lending to someone willing to put down a larger down payment. How long do you have to buy private mortgage insurance, PMI? Borrowers can request that on monthly mortgage insurance payment be eliminated once the loan to value ratio drop below 80%, once the mortgage LTV ratio falls to 78%, the lender must automatically cancel PMI as long as you are current on your mortgage. That happens when your down payment plus the loan principal you have paid off equal 22% the home purchase price. This cancellation is a requirement of the Federal Homeowner Protection Act. Even if your home market value has gone down. Types of private mortgage insurance. Borrower paid mortgage insurance. The most common type of PMI is borrower paid mortgage insurance, BPMI. BPMI comes in the form of an additional monthly fee that you pay with your BPMI mortgage payment. If you after your loan closes, you pay BPMI every month until you have 22% equity in your home based on the original purchase price. At the point, the lender must automatically cancel BPMI as long as you are current on your mortgage payment, accumulated enough home equity through regular monthly mortgage payment to get BPMI cancelled. Generally takes about 11 years.